Book income says one thing, but the tax return says something different. So what changed? Let's solve it through a practical Schedule M1 case study. Let's start with our company's financial information. We have sales revenue, service revenue, royalties, interest income, and several operating activities. At this stage, these are simply book numbers. Now let's continue with operating expenses. Everything looks normal so far, but hidden inside are several book versus tax differences, and those differences will drive our reconciliation. After combining revenue, cost of goods sold, and expenses, our pre-tax book income becomes $5.319 million. But notice these key tax adjustments. They're about to change the story. Financial statement income and taxable income are not always identical. Book accounting follows financial reporting rules, but tax returns follow tax rules. So the question is, how do we reconcile the difference? This is exactly why Schedule M1 exists. It bridges book income and taxable income, because some book expenses are not deductible, while some tax deductions exceed book deductions. Before preparing Schedule M1, we first gather the required information: book income, tax adjustments, and depreciation details. These become our inputs. Book income is $5.319 million, but taxable income is still a question mark. So how do we move from book income to taxable income? And which adjustments will change the number? Schedule M1 follows a simple 4-step framework. Start with book income, add additions, subtract adjustments, and compute taxable income. We begin with our starting point, book net income of $5.319 million. But here's the catch. Why can't we directly use this amount for tax purposes? First, let's identify items increasing taxable income: federal taxes, meals limitations, penalties, and amortization differences. We also have bad debt differences, accrued payroll adjustments, and charitable contribution limitations. Together, total additions become $324,500. Now let's move to subtractions. Tax depreciation exceeds book depreciation, and the dividends received deduction further reduces taxable income. Now we put everything together. Book income plus additions, less subtractions, and taxable income becomes $5.369 million. But wait, does the story end here? Now we connect the answer back to Form 1120. Notice that our Schedule M1 ending taxable income ties directly to the return. Here's how the completed numbers appear inside Form 1120. This is where our reconciliation becomes an actual tax file. And this taxable income becomes the foundation for future tax computations. Topics like Section 163J, GILTI, FDII, and more begin from here. Let's quickly recap. Book income and taxable income are not always the same, and Schedule M1 bridges that gap. This case study uses simplified assumptions and hypothetical scenarios for educational purposes. If you found this helpful, subscribe for more structured U.S. corporate tax case studies and practical tax return walkthroughs.